While the abatement process is the taxpayer's means of remedying an overassessment, assessors have a remedy when they discover the taxable property was not assessed at all or was underassessed for the fiscal year. However, this remedy can only be used if you did not assess or you underassessed the property due to an inadvertent or unintentional clerical, data processing, or other good faith error, mistake, or reason. An omitted assessment is a tax assessed on a real estate parcel or personal property account that was left out of the annual tax commitment and not taxed at all for the fiscal year due to the mistake. A revised assessment is an additional tax assessed on a real estate parcel or personal property account that was not assessed enough taxes for the fiscal year due to the mistake. Here are examples of why a taxable property may be missed in the annual commitment of taxes. A parcel may have been dropped during a remapping project, a parcel may have been treated as exempt, or a new business didn't file a personal property tax return, which is called a form of list, so its taxable personal property was not assessed. To make an omitted assessment, the parcel or account had to have been left out of the annual commitment because of a clerical, data processing, or other error or mistake that was unintentional. For example, a parcel of real estate was inadvertently deleted from your records or treated as exempt. If you made a deliberate or considered decision to not assess a parcel or personal property account, then you cannot make an omitted assessment for that fiscal year. You cannot simply change your mind about the taxable status of the property after the commitment. In addition, you can make an omitted assessment to assess the personal property taxes owed for a fiscal year because a business did not file a personal property tax return, the form of list, for that year, and an audit under General Laws, Chapter 59, Section 31A establishes that the business had taxable assets. The newly discovered personal property is taxable, and an omitted assessment would be used to assess the taxes owed for the years covered by the audit. Likewise, assessors may correct unintentional mistakes that result in property underassessments by using revised assessments. The underassessment has to be due to an inadvertent or unintentional clerical, data processing, or other good faith error, mistake, or reason. You cannot use the revised assessment procedure if you simply change your mind about the value of the property after the commitment. Here are examples of the typical situations where you would revise the assessment of a real estate parcel or personal property account. You did not include in the valuation of a parcel a new guest house, deck, or pool the taxpayer added because the permit information was not processed properly, or you did not know about the construction. A revised assessment may be used to assess the additional tax that would have been owed but for the error. If your city or town uses a split tax rate and you misclassify a property and tax it at a lower rate due to an inadvertent error in data entry of the classification code, you may use a revised assessment to assess the additional tax owed based on the correct and higher tax rate. In addition, you can make revised assessments to assess the additional personal property taxes owed when a personal property audit under General Laws, Chapter 59, Section 31A turns up taxable personal property that was not reported by the owner on its personal property tax return, the form of list. An assessment based on an incomplete listing of personal property assets is itself incomplete. The newly discovered property is taxable, and a revised assessment is used to assess the additional taxes owed for the audited fiscal years. There is a strict deadline for committing omitted or revised assessments for a fiscal year. It is June 20th of the fiscal year, or 90 days after the mailing of the actual tax bills for the fiscal year, whichever is later. Once the deadline for the current fiscal year has passed, you cannot make omitted or revised assessments for that year. However, a longer deadline applies if you are committing an assessment on taxable personal property discovered after a personal property audit. The deadline to assess the additional taxes owed on an unassessed or underassessed personal property account in that case is 3 years and 6 months after the date the personal property tax return for the audited fiscal year was due or was actually filed, whichever is later. The remedy for assessors to correct errors in the person or entity assessed the tax is reassessment. An assessment to the wrong owner makes the tax invalid. And if a real estate tax, makes the lien on the property to secure collection of the tax invalid. If you find that the wrong owner was assessed and the entire tax has not been paid, you should reassess the tax to the person or entity who was the record owner on the applicable January 1st assessment date. Note that if you assessed a real estate tax to an owner unknown for a fiscal year before fiscal year 2018 without first obtaining approval to do so from the Department of Revenue, the tax and lien are invalid. After you have conducted a reasonably diligent search of registry and probate records that does not identify a named owner and have voted to assess the parcel to owner unknown beginning in a particular fiscal year, you can go back and reassess the prior year unpaid taxes to owner unknown on the basis of that search. There is no time limit or deadline for reassessing taxes. The taxes just need to be unpaid. Note that interest on the unpaid tax runs retroactively to when the interest began to run on the original assessment. In addition, the lien on real estate is valid for the same time period as the lien on the original assessment if it had been correct. Taxpayers have the right to challenge an omitted or revised assessment or a reassessed tax by applying for an abatement. They have 3 months after the date the bill for the omitted or revised assessment or the reassessed tax is mailed to apply to the assessors. You cannot act on an application that is filed after the deadline. Let's review what we have learned in this lesson. You may assess additional taxes after the annual commitment in certain cases where a mistake was made and no or insufficient taxes were assessed. An omitted assessment is made to assess taxes on a parcel of real estate or personal property account not included in the annual commitment. A revised assessment is made to assess additional taxes owed on a parcel of real estate or personal property account. The omission or underassessment must have been due to a clerical, data processing, or other good faith error, not due to your deliberate decision. There is a strict deadline for making omitted and revised assessments each fiscal year. You must commit them by June 20th of the year or 90 days after the tax bills are mailed, if later. A longer deadline applies if the assessments are made after the completion of a personal property audit. You have 3 years and 6 months from the date the personal property return for the year was due, or actually filed if later, to commit those assessments. You also have a remedy for taxes that are invalid because they were assessed to a person or entity who did not own the property on the January 1st assessment date. You may reassess to the correct party so long as the tax has not been paid in full. There is no deadline for reassessing a tax. Taxpayers may apply for abatement of omitted, revised, and reassessed taxes. The deadline is 3 months from the date the bill for those taxes